Hello, everybody. My name is Devin Saxon. I'm a Senior Product Marketing Manager here at Swirlds Labs, and welcome to the final day of Hedera Ecosystem Week. We're going to be covering ESG and security on Hedera, and we've got a pretty good lineup, so let's go ahead and jump into the agenda. First things first, I'm going to give an intro, a little foundation on the ESG space, and then after that, we're going to follow up with a Guardian 2.0 discussion with Daniel Norkin from Envision Blockchain and Wes Geisenberger from the Hedera Foundation. Just going to be covering that open ESG framework and the ecological standards. Then we move on down to Matt Smithies and Peter from Saucer Swap, where they'll be covering Web3 security posture, the best practices for developers and Degens. And then finally, we have Alice from Chainabuse talking about playing it safe in Web3, with Matt Woodward, Swirlds Labs' very own, giving out the closing ceremonies for the week. So cool, let's go ahead and jump right into intro to ESG on Hedera. So first things first, what is ESG? What does that acronym stand for? It's environment, it's social, and it's governance. And I think the thing that you have to really realize is that investors, institutions, governments, organizations are all taking these three non-financial factors as a part of their analysis process to help identify material risks and growth opportunities within their business. And to apply that, as of 2021, more than 3,000 investors with over about $121 trillion worth of managed assets have now signed some sort of commitment to integrate ESG information into their investment decisions. So at that pace, it's about like a third of managed funds by 2025 are going to be under some sort of mandate. So why is that important? I think when we talk about sustainability today, and where you see organizations really giving out these sustainability efforts and initiatives in order to fight climate change, those initiatives are falling under this ESG sort of umbrella. So it's really important as an institution, as an investor, as an org, to really start to take these ESG focuses a little bit more seriously. So why do organizations need to care? Outside of the obvious of bettering our society, planet, and climate, these are sort of the factors that I feel like are top of mind for organizations when it comes to the topic of ESG. The first is around regulations. So you have this mandatory disclosure. We're seeing examples like the SEC proposing rules to enhance standardized climate-related disclosure for investors and regulation. So now companies are going to be forced to internalize and publicly report their climate risk assessment, including their use of internal carbon prices. Really, all these policies and guidelines are being put in place by governments and regulators. And in order to avoid penalty, which is kind of jumping to my third point, organizations really need to prioritize how that they're recording this data and how that they're handling their carbon assets. And that moves on to the carbon market improvements. So if you're thinking about these carbon assets, more commonly we're talking about carbon offset credits. And that represents a ton of CO2 carbon emissions that have been avoided, captured, or sequestered via various industrial, energy, agriculture, land use, and forestry projects, because each of those credits potentially can offset a ton of pollution or emission that's done by that organizations. So the sale of those carbon offsets are really generating a revenue to be able to fund those projects that are truly fighting climate change. And by having all these regulations and policies and having the data be available within the ESG space to validate that market is really key. One, in order to holding people accountable, but two, fighting climate change. And then finally, we have avoiding penalty. There's a risk of penalty overall. We've seen institutions have to pay fines, and some are even at risk of having executives lose job titles by not following these regulations that are set by governments and agencies. So as we understand why these bullets are present for organizations to really care about, we also need to understand the challenges that are in the space today and where we're sort of going with that. So the current challenges that are really kind of blocked the ESG have caused a lot of problems within the sustainability space, I should say, is one, lack of shared methodologies. So when we're talking about these policies and these different ratings that organizations will have to follow in order to qualify for a standard of ESG performances, we see that agencies are really inconsistent in regards to how they qualify one index for another. Because one institution could be in the green under one agency's parameters, but be in the red on another. And you can see how that causes a bunch of discrepancy, because what's really the truth and what's really valuable at that point. And another challenge is greenwashing. There have been institutions in the past that have made claims that they've they've impacted X percentage of some certain offset, or their emissions have gone down this much, and they're able to claim X number of improvement when it's really not true. And again, that ties directly to avoiding penalty piece, because when you do greenwashing, you make these false claims, that's going to lead to resignations of executives. And I think that including of the climate reporting and financial disclosures that we're talking about before is really helping fight these greenwashing cases, because now that data is going to be completely transparent. And then finally, double counting is a big one too. The double counting issue can be partly addressed through programs and project governance and mechanisms. But today, if that carbon market, you can sell one offset to one business and then sell that same offset to another business, there's no way that it's going to be able to count for offsetting the emissions of both businesses. So really, what is the solution at this point? How do we improve this process? How do we make this ESG, the sustainability space, the balance sheet of the planet to really hold everybody accountable? And it really comes down to these 5 pillars. And credit to Wes Geisenberger for creating these. We have making climate finance audible. All attributes of assets are known and linked to a specific asset. Data can be quantified, aggregated, and rated with full trust. Because when you have visibility into all the data, and people can analyze it, people can bring truth and validity to that data that we're seeing. Next is digitizing and open source methodologies. That problem of having agencies having their own particular sort of siloed parameters and what qualifies as an ESG performance should be a thing of the past. This will help make those trust models that these businesses want to use and have that consistency and flow to have a more consistent footing and limit any type of chance of discrepancy when it comes to that data or when it comes to what's actually valid and true. The next is scale validation and verification. The data in this space needs to be validated and verified on a distributed scale. We can do that by using some sort of distributed ledger technology like Hedera, which allows you, including the Guardian, to see this digital measurement report and verification of all this data, and then also tokenize it for these different markets. And with that, that will help us discover a global carbon price, By having all this open source and having all this data available and more transparent, we have better reason to give the prices to these carbon assets as opposed to done previously in these siloed sort of tunnels or tubes, you could say. And then at the end, that will help make ESG reporting credible altogether. So when it comes to having a DLT be a solution for that, you really need sort of all of these things. High performance, that finality in seconds, a high throughput. You need good security, something like a proof of stake system. Stability, so no forking of a network, ensuring that it's always up. The governance, we have treasury management, we have a strong roadmap, there's a community built around Hedera. And then finally, a sustainability piece. I think the Hedera solution in itself, carbon negative operations, and it's got the lowest carbon footprint per transaction of any public network, which really just fits this story of sustainability and ESG. And what that really looks like, the UCL research on blockchain technologies published in Q3 of last year stated that they found that Hedera has the most favorable energy consumption characteristics. 605,000 times less energy per transaction than Ethereum 2.0, and you have to conduct at least more than 70 transactions on the Hedera network to use the same amount of energy as one swipe of your Visa card. And I only say these things because in the space of all that data that comes around sustainability and all the offsets that need to be created in order to have a liquid market for carbon credits, that's a lot of throughput. That's a lot of transactions. It's a lot of real-time data that needs to be happening at once. And this just proves that Hedera is able to handle all of this. This slide is just talking about the Hedera infrastructure and how it supports it all. The consensus service, the token service, the smart contract service, all built on top of Hedera's Hashgraph consensus. That paired with the ESG space or the sustainability space, we need to be able to really bridge the raw data and measurement of all of these emissions, of all the carbon offsets that like to be in place so that you are able to create this ecosystem of sustainability. And that is able to be done through the Guardian. So Daniel and Wes will be talking about this shortly in a little bit greater detail, but the Guardian is a modular open source solution that includes identity management and DLT libraries for developers to get started creating ESG assets. Hedera joined the W3C to help define and incorporate both DID methods and recognize standards around carbon credits so that the path to policy workflow engine became clear. And this is how we created the Guardian. And I think the three big pillars of the Guardian that to me highlight some really great value are the policy workflow engine, because this helps manage and monitor the state of required policy actions and the required information flow needed. And this is just supporting that open source of methodologies and policies. I think before when we were talking about agencies having those silos of qualification, which really causes discrepancy across the space of what's actually valuable and who's qualifying for what. This workflow engine helps lower those barriers by being able to share those methodologies with one another. The next is creating ESG assets, such as carbon credits and offsets. It allows for this full discoverability and traceability of ESG assets and information to be put into actual practice with Hedera as you tokenize these assets into a marketplace. And then finally, again, the open source value of the Guardian, the shared information, helping building community, the eliminating of discrepancies, the sharing of methodologies. It's just showing why Hedera and the Guardian is a leader in this space in regards to being a DLT solution for sustainability. And here, I'm not going to go into too much detail, but here are a few kind of logos that are in the sustainability space that are leveraging Hedera. We have Avery Dennison empowering customers to offset their carbon footprint via offsets through us. We have Timeless enabling transparent, audible, and verifiable decarbonization through us as well. So the community is there. We have actual live use cases out, and we're excited to see where this is going. So what's ahead? I think the basic things. We have community growth, getting our marketing out there, putting more content out there, getting to more events. Also trying to grow the community as well as we give out more grants for people to build on top of Hedera and use the Guardian. We're going to be adding more features like an ARM repository, a Guardian policy dev, and then also would like to do something like Guardian as a service, as we see that institutions have limited resources. So when they want to make contributions towards their sustainability initiatives, they may not have time to really invest into building an infrastructure. So we want to take that away from them and just give them the Guardian as a service to use really quickly so they can just focus on their initiatives even more. Well, that is the intro for me, from my side. Next, we will be moving on to Guardian 2.0 with Daniel and Wes. So enjoy the rest of your Friday.
Hello, everyone, and welcome to today's webinar. We're really excited to be part of Ecosystem Week. My name is Wes Geisenberger. I help lead the Sustainable Impact Fund for the HBAR Foundation, where we're focused on building fully auditable and efficient sustainability markets on Hedera, and we're very focused on bringing the balance sheet of the planet to the public ledger. During today's webinar, we're going to go over some of the key challenges, as well as the industry trends in sustainability, some of the things that we're doing across the Hedera ecosystem, both at Hedera, Swirlds Labs, the HBAR Foundation, and many applications building on Hedera, and talk about some of the infrastructure that's out there, and how folks are using it to create real-world impact and outcomes. But first, just a little bit of a history of what we've done as part of the foundation and the Hedera ecosystem. Back in March, we launched the $100 million Sustainable Impact Fund, which was focused on anywhere within the UN Sustainable Development Goals where we could enable fully auditable outcomes that are data discoverable and ultimately lead to liquidity in climate markets. And we've made a lot of grants since then that are powering applications that are all around the world, such as DOVU, who has projects across the UK as well as Bulgaria, CRIPSI, working with large solar power providers in Dubai, such as Amana Solar, Timeless, our first grantee out of Australia, who's been working with governments like the Queensland government, but also partnering with AMIC, a conglomerate that is a public-private partnership between Airbus and the Malaysian government, as well as many others. We've gone into water with grants like Civic Ledger, as well as large opportunities like measuring emissions through Atma.io and Avery Dennison, looking to decarbonize supply chains. We launched our first grant in Africa focused on emissions reductions in Kenya with Sync.io and Temua, who's the largest renewable biomass producer in Kenya. We've also looked at how we make this information much more discoverable through explorers like Miko's Trustery platform and LedgerWorks EcoExplore, in addition to looking at biodiversity and conservation markets with folks like the Perini Foundation, who've created nature collectibles to make it easier to get funding back to folks enabling conservation. Now, taking a step back and looking at, well, what do these markets mean? What do they actually do? And at the Sustainable Impact Fund, we've looked for a long time at enabling these auditable projects following specific rule sets, as well as how we can take those rule sets, produce data that can create tokenized outcomes. But in order to create these projects, you actually need sustainable debt oftentimes, so that you can pay for the initial upfront cost of how these outcomes happen, whether it's in a green bond, a sustainability linked bond, or any other climate asset that ultimately enables things like the voluntary carbon market, which is one subset of the market, to exist for folks to be able to voluntarily offset their emissions and ultimately report. And so just two segments of the market I wanted to highlight is the sustainable debt market, and even looking at something like green bonds, which was not so big an industry not that long ago, and recently hit a big milestone of going to over $2 trillion in green bonds and $3.5 trillion overall in sustainable debt, with a goal of getting to $5 trillion a year in sustainable debt by 2025 as set by the Climate Bonds Initiative. And we have the voluntary carbon markets, which earlier this year reported hitting $851 billion in a year, and now has gone to over $2 billion in the past year, which is a really, really exciting opportunity to see a growth trajectory in two of the market segments, one much bigger, of course, than the other, but they're both growing at a record pace. Of course, each of these types of markets have challenges. In sustainable debt or even traditional climate finance, there's a lack of auditability. It's hard to know who's funded a project, how much money are they making on that project, who's actually getting paid, from a project developer to a consultant to a validation and verification body, and making it easy for the average person to understand, partially because a lot of times this information is trapped in analog systems, in PDFs, where rule sets are very complicated to understand, and it's difficult to understand how they're being put in practice and how the data that's being produced is related to them. It's often very difficult for folks who are validation and verification bodies and project developers to even agree on that data or get it into a state where a registry can actually verify that that information is properly following all those rules so credits can be issued. And so there's a lot of friction in this process. And ultimately, when these assets are created, it's hard to differentiate one versus another. And there's price transparency issues where you don't necessarily know if that credit was sold for a forward, how that financing worked, if folks are getting paid in a way that is proportional to the work that they're doing, and ultimately what that project, if it was bought ahead of time in a forward or any other type of vehicle, was actually what it actually is going to be sold at after the fact. And when folks buy these assets, whether it's a forward, a credit, or any other type of instrument, how they're being reported is a big topic of discussion. There's many different ESG reporting metrics all around the world, whether they're in compliance markets or voluntary markets. And oftentimes the data that's trapped in these analog systems isn't able to make it into a reporting structure that is fully digitized, that's linked back to the projects that are happening in the real world and the financing that made them happen. And so at the HBAR Foundation and in the broader Hedera ecosystem, we're trying to address that. And one of the big ways we're trying to address it is bringing the balance sheet of the planet to the public ledger, because we believe that the balance sheet of the planet will live on a public ledger. In order to enable this balance sheet, we need to build a regenerative economy that's fully auditable, both on ledger in terms of things like prices, but also from an information perspective, knowing all the roles and actors, understanding how they're related to each other, and making sure that data becomes information that's human understandable. And not just human understandable, but as we get beyond analog systems, making that information machine understandable so that we better can determine a price for those assets in a way that brings liquidity to the market, and that liquidity is based on the information in a given project. And so to break that down a little bit further, when we think about auditability, we need to know the rules we account by, such as the methodologies, the roles and actors who are fulfilling those roles, and the data that they produce with a trust model built in that leads to quantifiable outcomes, whether it's metric tons or megaliters of water in the case of Civic Ledger working in Australia. And we need to be able to see what those assets look like. We need to know every single attribute, how that's linked to the specific asset, why it's important, who is involved in calculating that information or collecting that information, and understanding what their reputation is. Were they following the rules? Do they have a history of following the rules? And quantifying and aggregating that data in such a way where you can get back to the source, but understand it in context, all on public ledgers. And ultimately what that enables is for folks to look at this information, search for it, and make buying decisions. They could also make other decisions like governance decisions. Maybe there's certain assets that need further scrutiny, or some assets that are really helpful towards solving our toughest environmental challenges, and being able to invest money into those assets based on those specific attributes that are helpful to solving the toughest challenges in the climate crisis. And ultimately, looking at how we can make sure that these assets flow in such a way that we can buy hundreds of thousands of them at the same time, make sure that traders can trade, but we're not losing the fidelity of information that drives a real world outcome. And so we've set up 5 goals at the foundation that we invest by. And we want to make climate finance auditable is the first one. We want to understand where money's coming from in these sustainable debt markets and making sure it's aimed at achieving the outcome, but it's also able to follow through. And the way that we follow through is we set up these digitized and open source methodologies. We understand the rules that we're going to abide by and how we collect data, how we measure, report, and verify that information. And we partner with folks who are doing validation and verification in such a way that we can scale how this information is digitized, and not just automating it, but enabling folks to use public ledgers in a discoverable way where information is able to empirically improve over time. Folks can get better at processes because they're digitized. They can become more consistent. We can get an understanding of what works for a specific project because we know the rules and we know what is going to provide a high quality response in terms of measurement, reporting, and verification. What is going to enable folks to get to an auditable outcome that can prove that a metric ton has been captured or sequestered or removed is part of a sustainability project. And ultimately, when all of these processes happen, whether it's the process of an audit or whether it's going through verification and ultimately the mint and issuance of an asset, we can actually put a price on that asset because all of the information is tagged in such a way that we can understand it and understand its impact on the environment in such a way that we can derive a value from it. And when folks derive a value from it, they can balance it against the natural capital liabilities that they have, whether it's emissions, water consumption, or any other biodiversity liability that they may have. And ultimately, hold these assets not just on their balance sheet, but against the claims that they're making that they report to any type of NGO, non-governmental organization, or a national organization where they're showing that they're making a positive impact in such a way that they can claim net zero or go beyond net zero. Our goals match the sustainability market life cycle, going from emissions reporting to investment to mitigate those emissions or reduce those emissions in my traditional business processes, but also enabling investment in new types of financial vehicles that enable auditable projects that can be ultimately discovered and traded or retired to satisfy my goals as a company or any company's goals to meet their reporting requirements. Of course, there's many processes where folks who are project developers want to make sure that their projects, if they're standing them up themselves or using a financial vehicle, can be liquidly traded and ultimately enabling organizations to buy them and understand exactly what's happening to satisfy their needs so that when they report and disclose the types of assets on their balance sheet that they're claiming a benefit against, they can say they've satisfactorily done the due diligence that is fully auditable and discoverable on a public ledger. At the HBAR Foundation, we've invested across the sustainability market cycle. We've invested in project funding, market supply across a series of methodologies and a series of digitized policies that are matched to those methodologies to make sure we have a robust set of applications and projects that can be invested in by project funders through tools like carbon forwards, but ultimately have discoverable data as shown by data management tools such as LedgerWorks EcoExplore, where data can be interpreted by new types of trading tools such as Tolum Earth's Automated Regression Market Maker, which is an open source tool that enables efficient discovery of environmental attributes that leads to better pricing for these assets that can enable buying from many projects for a single buyer rather than just one or two. By leveraging the ARM, large-scale emitters can efficiently buy assets, and those assets can meet their needs across any type of co-benefit or type of project and methodology. The ARM is able to interpret based on what co-benefits are required or what regions are required or what environmental attributes are important. Now, some examples of scope 1, 2, and 3 measurement tools are Atma.io from Avery Dennison, as well as Timeless platform, which are both working with enterprise customers to measure their environmental footprint and ultimately enable offsetting. Of course, and very importantly, we need to enable reporting so that we can work within the constructs of how the market reports today, and those are the types of areas that the HBAR Foundation invests in. But to get a little deeper in this, when we start at the beginning of the market cycle, we need to think about sustainable finance. And so one of the big investments that we've looked at in terms of an area of need is thinking about green bonds and carbon forwards. And ultimately, this process is very opaque to most parties. It requires folks to understand how an asset's structured, the enablement of issuance capabilities, and making sure we meet standards to ultimately go into the monitoring and reporting lifecycle for an auditable project. To give a granular example, we're excited about some of the opportunities where we can link green sustainable debt to auditable opportunities in market supply. One of the recent announcements was the partnership with Evercity, who enables structuring, issuance, monitoring, and reporting on the public ledger, where we can understand how projects are onboarded, meet specific sustainable debt requirements, and link that sustainable debt to the monitoring and reporting required to go through an auditable project on Hedera. And what's unique about this opportunity is by linking these two markets, we can actually build new types of attributes while providing transparency to issuers, investors, and other parties involved of the flow of finance to specific areas of a project following digitized and open source methodologies. What we're able to do is track funding from sustainable debt instruments to the specific roles and actors who fulfill those roles in Guardian-based issuance in order to not just have data traceability, but financial flow traceability to understand what percentage of a project is going to investors and what percentage of the project is going to the folks doing the hard work to stem our climate crisis. When we look at this in a flow, we can understand how a green bond goes from commitment and PDD all the way through registration, financing, and issuance of forward credits. From there, what we're able to do is look at the methodologies and actors that are being selected for projects, including those who are fulfilling roles of validation and verification bodies, auditors, and other project consultants that help build out the data. But also, as this data is produced, we can better understand the relationships of individuals, enterprises, governments, auditors, and regulators in the process. And of course, on Hedera, what this looks like is a series of audit trails, leveraging our consensus service, using things like the Hedera DID method that are linked to auditable tokens on Hedera as they're issued in the form of carbon credits or an equivalent asset. And what the Guardian does is it allows folks to build efficient policies that link digital identities or digital identifiers in the form of DIDs and verifiable credentials that represent devices, systems, and people, and the accreditation or the attestations that they have the rights to do a specific role within a policy workflow. From this, after we're able to validate information and verify it, following the different standards, tokens are able to be issued and held in wallets on Ledger. These tokens that are held are able to be sold and traded or retired against environmental liabilities. Now, to be a little more specific, one thing that's very different about Hedera is we're able to bring sensor-based information following measurement, reporting, verification standards in order to mint these assets. This data, as it's being reported through the Guardian, is validated to follow the rules and ultimately enables folks to understand the relationship of data to the rule sets and tokenized outcomes. We're able to do this because of the way credentials are issued to assert that someone has the right to do a specific role. And those folks may have the right to either issue other credentials to devices or people, or they may just have the right to audit that information, but ultimately linking back to a token in a rule set. If we look at it a little differently, we're able to see the entire flow from investors to create assets like forwards that ultimately fund projects that have methodologies, specific actors that issue tokens that can ultimately be retired or traded in the market. One specific example of this, which you can find on LedgerWorks Eco Explore, is the GCC Solar Rooftop project done by Cripsy, as seen on LedgerWorks. And what you can see is the Amana Solar Rooftop project is following GCCM 001 and looking at how we can mint types of credits on these rooftops that Amana is helping develop. Of course, this is one of many projects following many sets of methodologies that you can see out there on GitHub in the Guardian GitHub repo under the Hashgraph repository. Our entire ecosystem is working together to help achieve some of the goals that we've talked about today, whether it's making sustainable finance auditable with EverCity and issuance of green bonds and carbon forwards, whether it's the many projects, names that you see here, who have open source methodologies and are enabling the scaling of validation and verification by using these automated digital systems, but also are working with individual validation and verification bodies and registries to enable the manual process where it's required, and ultimately enabling these assets to trade on marketplaces such as the ARM to find efficient price discovery for these assets and ultimately enable retirement against folks who are measuring scope 1, 2, and 3 emissions, such as Atma and Avery Dennison or Timeless. And so with that, I want to transition to some of the folks who've been helping develop the Guardian since early 2021 and since the Guardian's release in October 21 of last year, or October 2021. So now I'll pass it to Daniel Norkin, who's the co-founder of Envision blockchain, to talk a little more about their work in developing the Guardian, their newly launched managed Guardian service to make it even easier to create digital environmental assets on Hedera, and want to thank everyone for joining today.
Thanks, Wes. Hi, everybody. My name is Daniel Norkin. I'm one of the co-founders here at Envision Blockchain, and we're super excited to be talking about Sustainability Week over here. So just like Wes was talking about the policy workflow engine and why it's so important and the methodologies that the policy workflow is really a coded version about, it's really important to understand that the policy workflow engine, it's a core component of the Guardian system. Its main purpose is responsible for managing and monitoring policy actions and determining the next steps based on the current state of a policy workflow. And that could be such steps such as submitting application forms or even uploading satellite imagery. Now, we're going to be introducing the Managed Guardian service, which is a hosted version of the Guardian. It's going to be very similar, but just keep in mind that by having the Managed Guardian service managing the policy workflow engine, it ensures that the carbon claim validation and verification are both reliable and auditable, as well as ensuring that the underlying cloud infrastructure has a high uptime SLA. The infrastructure is designed to be scalable in order to handle high data streaming workloads, and the Managed Guardian service is built to be able to handle high demand and recovery from failures. It's also very important to mention that we've included a new element into the Managed Guardian service, which the open source doesn't quite have, and that's the ability to have multi-tenancy. So this allows for the ability to have multiple tenants, again, for different applications. We've also included internally a robust monitoring and alerting system to help detect and prevent any issues, hopefully before they reach to you. If they do reach to you, however, the Managed Guardian service team has a help desk for support. It's built right into the application. And then, of course, as always, Envision Blockchain is always there to help provide additional assistance, such as development needs for anything advanced. But what we want to do is really talk about how far the Guardian has really came from when it was first open sourced, basically almost 2 years ago, to where it is currently today. And in order to do that, I think that the best way to demonstrate this is actually to showcase the Managed Guardian service, because again, keep in mind that there really is no main difference from the Managed Guardian service to the open source. It gives you that stable and reliable cloud infrastructure. So, you don't always have to keep rebuilding it every time that you want to use it, of course. So what I'm going to do right now is I'm going to be sharing my screen, and we're just going to go through different clicks and different screens and talk about some of the new features that we have over here. So here we're logged in as, of course, one of the most important users within the Guardian roles, and that's, of course, is the standard registry. Again, just to kind of mention that there are a couple different roles within the Guardian. We have the standard registry, whose screen that you're looking at right now. The standard registry is a role that creates schemas, creates tokens. Essentially, they create policies. And the policies are just coded versions of the methodologies that are needed in order to follow in order to get some sort of a carbon offset emission or some sort of offset or some sort of credit, right? So again, this is the standard registry screen. And in here, you could see that we've really enhanced the ability to kind of tell between the different schemas that we have. Now we have the ability to filter between policy schemas and system schemas. We also have the ability to create schemas, and the ways that we can create schemas are really, really in depth. We can add fields. We have a whole bunch of different schema types, and we're always growing right now to kind of support new schema types as the time goes on. Of course, we have, again, policy schemas, just like we mentioned. And policy schemas, again, are really the data structures behind the verifiable credentials of what's needed in order to fulfill methodologies that are embodied within policy workflows. Clicking onto the next screen, we have tokens. Tokens This particular screen hasn't really changed much since the inception. However, it is important to note that there are ways that we can go ahead and view tokens through different explorers. For example, the Ledger Work Explorer, which is a member of the community, they have a great explorer to go ahead and take a look at the different token types, as well as the different the flow and what's going on in the Hedera topics as well. We have the artifacts tab, which is a little bit new. You have the ability to import artifacts, which are very specific to policies. And then if we take a look into policies, this is where you're really going to see some of the main differences. Again, we wanted to make sure that the standard registry roles really have an enhanced opportunity at creating policies. So in addition to just creating a policy from scratch over here, you also have the ability to import policies. And what's great about importing policies is that you can either import policies directly through a file, you can import policies through IPFS, through a timestamp, or within the Managed Guardian service, we make it really easy to go ahead and import policies. It's all coming from a preloaded list of policies. What's interesting though is if we can go ahead and take a look at a policy. So for example, let's take a look at one of the open source policies. We'll take a look at IREC, which is a tokenization of renewable energy certificates in accordance with the IREC standard. We can go ahead and open this up. When we open this up and we'll expand the policy workflow, you can see that we've added a whole lot of new elements in here to really understand the flow of the workflow and how all these different workflow blocks interact with each other. So not only do we have the ability to tie these different blocks together, we call those events. See, we have output events, input events, but we also have the ability, as usual, to define different UI elements. So if we scroll down, we can see that we have UI elements that pop up. Again, and this is needed for the other users, not just the standard registry, to be able to submit certain requirements within that policy workflow engine that we just mentioned a little bit earlier. So this is a really, really enhanced ability to create policies. So now if I were to return back to the policy screen, there's a brand new mode that we've enabled, and that's called the dry run. And I personally find the dry run a really interesting and very helpful mode. So if we go into the dry run, you'll notice that this mode prompts the ability to run a policy without actually hitting any of the Hedera consensus topics or any of the transactions. And the important part about it is, as a project developer, you may have a policy that you built and you want to just test it out and see whether it works without incurring any fees. This is where the dry run ability really, really helps out. Because what happens is when you run this dry run, it essentially just runs in memory so that you're not getting charged with any transaction fees. Granted, no tokens are being minted and no transactions are being logged, but again, you're just running this, just hoping that everything works out the way that it is. And essentially what happens is that you start creating your different types of users, and then you follow the workflow the way that it's required. Something else to note is I'm flipping over to the registrant screen right here. So again, the registrant is part of the IREC workflow. And you can see over here that there's one new button over here. And we have the ability to create multi-policies. So what's interesting about that is that you can string different policies together as you see fit. And that was a new piece that was requested by the community, wasn't there during the beginning launch, but we're happy to include that as well. So just again to reiterate, over here we're looking at one of the users of the Guardian that happened to register as a registrant. And again, that the reason why they are a user is because they wanted to go ahead and associate themselves to this IREC policy. So let's just go ahead and take a look at what's called the trust chain, right? So again, if I were to go into the policy as a registrant, you see they would have the ability to, create devices, register devices, issue requests. And then of course, as a registrant, they also want to be able to receive the renewable energy credits. So what we'll do right now is we'll flip back over to the standard registry view. And again, we'll take a look at the IREC policy. And let's take a look into this instance. And let's just go fast forward over to the trust chain. Again, the trust chain is really the whole reason why we have the Guardian in the first place, right? Because we want to be able to provide discoverable and auditable environmental digital assets that, again, the policy workflow engine dictates the methodology and the workflow of how these assets are created. So it's really interesting to note that we can see these verifiable credential cards over here that show literally every step of this policy workflow engine action and what happens along the way, such as registry being created, policies being created, applications submitted to the issuer, application and KYC being processed, device registration, device review, issuance request, and we can go all the way down to something called an issue request chunk. And I think that this is important, and I just want to mention this. Again, we're constantly looking at improving not just the plumbing, but also how things could be visualized. So you can see over here that we have these different cards that show, for example, different MRV data. So as we can see right here, if I were to open up one of these cards, and we'll scroll down through this test data, and you'll notice that in this card we have 10 kilowatts. And for example, if we were to go to another card, we can scroll down a little bit further. And we can see, for example, 930 kilowatts. So again, what's really, really interesting to note over here is that this trust chain gives you a way that you can see why your tokens were minted and all of the policy workflow engine actions that took in order to get to that token event. Again, we really think that this is a great way to introduce ESG to Web3, and we're happy to provide this in both an open source version via the open source version of the Guardian, or through a hosted service called Managed Guardian Service. So again, thank you so much, and we hope to hear from you soon. Take care.
All right, let's do this. Now, when Brady came to me very politely the other week and said, "Would you kindly do this?" I said he wanted strictly the powers at Hedera wanted like a very kind of serious talk on Web3, security and security fundamentals for everyone. So we thought in our divine wisdom, why don't we just create something completely opposite? So in this presentation, I'm going to teach you how to get rugged. So you can follow this for all the insight you need to lose all of your money. And so let's continue. Who are we? Well, I am Matt Smithies, the CTO of DOVU, and unfortunately we were supposed to have another guest with us, but he's sick at the moment, so it's just me for the next 15 minutes to half hour. So I hope you enjoyed the ride. And now, note that this presentation is for entertainment purposes only and does not reflect the views, opinions, or any other nonsense related to our employers or projects that we are affiliated to, for legal purposes only. So let's carry on. I'm going to teach you how to get wrecked. Now, you have 7 rules for success here. When a new project comes up and people are excited about it, just FOMO into it. That's fear of missing out. If the teams are completely anonymous, that is, they're using fake names, or they look like robots, or they have copied their NFT profile from somewhere else, just jump in, or ape in, as the cool kids say it. And always assume that the number will always go up, because that is the only way to live. Especially if you can't sell your tokens, then the number will always go up. And remember that if a project has high social numbers, that is always good. Believe that everyone has good intentions and they will never do you harm. And remember, finally, well, this is only point 5, you could lose vital gains if you research anything. So you may as well jump in and spend your monies. And finally, well, number 6 point, because we're not even on the final point, you have to remember that you're doing this to make your life better. Perhaps you have a family and kids, and perhaps you're looking at the North Star and thinking to yourself, if I jump into this project 10 years from now, I'm going to make my life better and my family's life better. So it would be best to leverage all your crypto, because of course this time is different. And just to confirm, these are your 7 rules for success, fully losing all of your monies. Now, the Degen mantra. Just remember, every project you jump into is going to be successful. If it isn't successful, it's okay. Next time, it's going to be different. And just keep repeating that to yourself, and just keep repeating the same old, we're all going to make it. But if you pull your money out, you sell your crypto, you redeem your crypto even, you're not going to make it. So you have to stay in there. Don't worry, we're all going to make it together, chaps and ladies. Now, oh no, the worst has happened. The number has gone down. Don't worry, there's the grief model. Assume that everything is okay and the number will go up. Just deny it, it's absolutely fine. Now, what you can do next is divert blame. It is the project's fault, not yours. Have a bit of anger in there. Show your rage to the world, because that will really fix your problems. And, you know, if you really want to, send threats of violence. This actually happens too much. And now you could probably start bargaining. So you could ask the team for a refund or just more tokens in the project, because of course the number's going to go up again. And if that doesn't work, you could offer to help the team to make the project work for more tokens, because the number will go up. And then finally, you'll realize in a state of depression that it's all your fault and you just keep making bad choices. And then finally, you come to accept that the incentives aren't really aligned in your favor. And this is unfortunately crypto during a bull market for many people. Now, as I said before, don't worry. There's always going to be another project. You'll make it all next time. And so one week you could be burning down. You could be, you could just be sitting there, worried, but a week later you'll find another project and you'll know you'll earn it all back. So keep going strong. But to be perfectly frank, we have to be serious here, because there are people who have a propensity for gambling, and within crypto, within these kind of high stakes environments, if the people around you are making it and you want to kind of join in, you want to kind of be part of that crowd, and it's easy to be manipulated, it's easy to keep going. But you have to be careful, because during a bull market that we had, the last couple of years, it's easy to make money, but during the time, the bear market, you have to really be careful, and it's easy to be taken advantage of. Now, we have to remember, regarding price or token value, the majority of it is completely speculative, and it's driven through framing, marketing, and community. Because cryptos, non-stable backed crypto, is non-fiat backed, hype, excitement, FOMO, all these things drive markets and drive price, especially in non-regulated environments. And the bottom can just fall out, and many people can fall prey to that. Now, as you've kind of gone through, and hopefully many of you out there haven't experienced, like the rug pull or becoming wrecked, it becomes, easier to be manipulated during these excitements, but you have to think about influence within the context of crypto and within the context of blockchain. And these are tied to this book called Influence. And it literally is a fever dream for crypto. If we look at these 7 steps, reciprocity, think of an airdrop. Think of you interacting with a kind of company, a project, and they say, we'll give you X tokens. We'll keep on giving you X tokens, or we'll give you a little bonus here and there, or we'll give you an additional role in Discord. And because they provide upfront value, they can make a much bigger ask later. It could be an investment in their project. It could be anything they want. They're just basically framing you. And this ties nicely into commitment. What if we ask you to make a little action, share some details on social, say yes to something? These small little actions you can imprint within your audience, and these small actions can become repetitive behaviors, and they can grow into bigger items. So that's how you get the kind of cult following. And then we think about social proof. So this is like a big influencer, Twitter, YouTuber. These influencers have hundreds of thousands, if not millions, of fans, and they can use that social capital to manipulate not only their fans but you, because you would believe that a project is legitimate. And now most of the time projects don't make it this far, but this is just part of the influence cycle. And then authority. Think about some of the biggest projects why biggest and legitimate projects why are they exciting? It's normally the team. The team has something about them that is exciting, that is knowledgeable, that they're trying to push the envelope. And now liking, if you kind of take the cult language within crypto, WAGMI, we're all going to make it, we're not going to make it, mirroring behaviors. This is a way for people to manipulate you further by kind of coming down to your level. So someone can come into your Discord and just community managers can talk to you, and it's almost like a sales cycle. You can feel like you're more connected with them. And then obviously coupled with that, we have scarcity, and this is the actual token itself, NFTs. So there are only going to be 1 million tokens. I want one of these tokens because they're going to be rare, or there's going to be these NFTs that are all different. There's only going to be 100 of them. And even if these items aren't tied to necessarily kind of utility, there can still be a speculative, and in most cases, the speculative value of them outshines their utility. And then finally, this idea of tribalism, unity. Why is our blockchain, why is our project better than others? And this is one of the items that is beneficial for projects to grow, because that's how you gain your fans that will love your project, that will do what they can. They're kind of the hardcore fans. But it just becomes this bubble where more and more people just focus on being a maximalist for Bitcoin, for Ethereum, and you just get these silos of people. Now, with that in mind, you have to think about the incentives. You found this amazing project, and you think that it's gonna you'll be able to profit from it, or whatever you want to do with it. Assume that you are exit liquidity. And what I mean by that is assume if you find this project and you throw money at it, that you're not the first person to do so. That there are bigger players, like the team, that potentially have the resources to extract value from you. This ties into liquidity pools that we'll cover later, but always assume the worst, that you are exit liquidity. And assume and accept that crypto is an engine for manipulation. Going back to the previous slide on these core principles for influence, you can see how they stack together to gain an audience and to manipulate them. Then you can always look at staking platforms, you can look at liquidity pools, you can look at bonuses and airdrops as different ways for getting an audience to do what you want them to do. And during a bull market, it's more and more easier to make things happen. And even if everyone has the best intention in the world, and even if it is a huge project, and even there's a lot of hype around it, the value, that the tokenomics, the utility can be fundamentally flawed. And that was present earlier this year with Terra USD, where you had this stable coin that effectively ended up at zero. And the reason is because for its core tokenomic utility or value, where it was pegged and minted to the Terra Luna coin that was non-fiat backed, and it was a completely speculative price, which economically wasn't stable. Okay, liquidity pools. We mentioned this earlier, but what they enable is this idea of trading on decentralized markets. And the best way to kind of think about this is you have what's called a bonding curve. A bonding curve describes a balance between two equally kind of inserted assets of the liquidity pool. So imagine if I create 100 MAC coin, and then I have next to it 100 USDC, and if I smash them together to create a liquidity pool, that is now tradable on a marketplace such as SourceSwap or Tangent Finance or whatever kind of exchange there is. And when people come in and they want to kind of swap their US dollars for my kind of MAC coin, it makes the MAC coin rarer. So if the MAC coin was previously worth $1, if there's less in this kind of balance, the MAC coin may be worth $1.10. Now, the kind of crazy thing here is you're almost creating value out of thin air, because if you have $100 of value and then you add another token onto it, you can always trick yourself into thinking there's $200 worth of value. And that's the wrong way of thinking about it. especially imagine if you held 100 MAT tokens, but there was only 100 MAT tokens in the liquidity pool. If you try to sell, then you wouldn't get $100 back. You may only get $50, $25, because every time you sell, there's this idea of slippage. And that's something you've got to be kind of very aware of, because you could have a token worth $1, worth $10, but if you can't exit from that position, then you're screwed. And this also ties into this concept of rug pulls. There's this hot new project that appears out of nowhere, and they have this liquidity pool that you can swap their tokens for, and everyone's really excited about it. And the number keeps going up. The number keeps going up, and then you suddenly can't trade. Your tokens are worth nothing. And normally, what happens there is the actual company owns the liquidity. So if they put in a bunch of their tokens and some ETH or whatever currency we want to not name here, as you come in and buy more of their tokens, it would actually give them more Ethereum, let's say hypothetically. And their bank of Ethereum within the liquidity pool would be quite high, so it could go 10x, 100x in terms of value of Ethereum. And then all they need to do is click a few buttons, and hey presto, they can extract all the value from the market, thereby removing the ability for anyone to trade or exit their position. And generally speaking, when you're using liquidity pools, we're thinking of the Uniswap v2 because of the open source nature. And this is the whole concept of bonding curves, linear bonding curves, where every trade has a price and a slippage. Solutions, how not to get wrecked. So we've made it through the bad part. The good news is we're in a bear market. Yippee! This means that you're less likely to be manipulated and lose more money because everyone is naturally more kind of cautious. Hedera as an ecosystem is a relatively new tech. What tends to happen in these other ecosystems, these other EVM ecosystems, is they do what is called forking code. And what forking code basically means is basically taking a copy and deploying it themselves and trying to get their metaphorical fishing rod out to kind of fish for new investors to jump into a token. But on Hedera, as everything is new, there are obviously scams and issues, but everyone is more aware that these things can happen. Our role here is to give the community knowledge about these things all happen to you, but just try to be aware. Every new project that you kind of look at, you shouldn't necessarily jump into. Actually, you should never jump into. Always check the socials. Never think to yourself that if a new project has jumped up and it now has 10,000 followers in the course of 24 hours that it's legit, because it likely isn't. Check out the websites. Always try to find white papers or teams. Ultimately, it is up to you whether you're comfortable with the project, but you can tell pretty quickly if you go to a website if it's a template. And by a template, I mean something you feel like you've seen before. The shapes seem very similar. And this is a really cool one that I found the other day, but I'm not going to mention the project here because I'll probably get in trouble. But it's very likely, if it's a copy and a paste kind of job, you'll be able to go to the documentation and literally copy some text, go to the original project and literally find a like-for-like plagiarism. And if you see that and there isn't kind of more meaning behind it other than what is found in the original documentation, then it's probably a big red flag right there. And of course, patience is key with anything. There is no get rich quick in this world. You need conviction, you need patience, you need to believe in the projects you're supporting, and you want to be a part of the community. You want to be there for the long run. You're not going to make your life better instantly. Now, with regards to Hedera, there are a number of token tools you can kind of use. It is kind of unique, the HTS tokens, the Hedera token service tokens, that there's this concept of different keys you can have. There's admin keys, there's burn keys, there's wipe keys, supply keys. And the first project that's come out relatively recent by Headstarter is this concept of like Sentinel. You can actually click on that and you can kind of run through a bunch of different projects, and they've basically reviewed them. They have their own methodology, and so you can double check on this website if you want to see if a project is legit or not. They've got a very small amount of projects at the moment, however it's worth checking out. And for NFTs are funny actually, because ever since they came out last year, people have been trying to work out how to deal with keys and using third-party scripts, things they don't really understand from a non-developer point of view. And what has happened is a lot of the old NFTs have had admin keys, have had wipe keys, all these kind of dangerous things inside of them, which means they could be manipulated or removed from users' wallets in the future. And I would say the Go Mint Explorer, check that out. It is incredible, and you can have a look at every single NFT on mainnet or testnet. Look at the exact serial number and check if it's a mutable kind of NFT, or if there are some keys attached with it that could be a danger to you, and that would be a nice red flag for you to take a look at. And so yeah, this is kind of like the final slide, and obviously we started all fun and joy, how to lose all your money, but the goal of this entire kind of presentation is simple. If one person sees this behavior within themselves, sees how they could be manipulated, understands the excitement of it all, the kind of the gambling propensity, let's call it, I just want this knowledge to equip them with a new lens of perspective. Save yourself from pain, save yourself from losing 10 grand, 2 grand, 10 grand, $1,000, however it is, because it's not worth it. So yes, that is the presentation. I hope you enjoyed it and or learned something. Thank you.
So hi everyone, thank you so much for joining. I'm Alice, building and leading Chainabuse, which is a collaborative layer on a mission to make Web3 safer, and we are grateful to have Hedera as an amazing partner. So today I would love to introduce you to Chainabuse, what we do, what we enable, and how we make the space safer. So what is Chainabuse and how it works? So Chainabuse is the collaborative layer enabling a safer Web3 for all. How do we do this? One is we currently fuel the largest database of scams worldwide, multi-chain, including Hedera, as we power a network of partners. They can be leading crypto organizations, trust and safety pre-vetted providers, leading investigators, law enforcement partners, and victims that we empower to report scams seamlessly on our platform. And as such, what we want to do is solve the data sharing problem, enable everyone to share information about scams. As a result, we have this database of scams, and we are able to empower both our users and partners at every stage of their protection journey. I will show you how in a minute. Why? Because they can use Chainabuse to verify addresses and domains before they sign transactions, but also to protect and alert their users directly in their product. And something we're launching super soon that I can show you in exclusivity today is we're about to offer users personalized instant scam support when they have been a victim of scam. And lastly, the way we make Web3 safer for all is we're also able to support law enforcement partners with on-chain investigation. For example, to accelerate tracing of funds in and out, enhance collaboration across agencies, and help them contact victims of scams more seamlessly, the ones who report on our platform. So I would love to show you concretely how it works visually. And if you have any questions, you're also always welcome to contact us at hello@chainabuse.com. But currently, how do we first allow our users and partners to report scams seamlessly, and this enables us to maintain the largest database of scams. Basically, users, victims of scams, can report a scam seamlessly on our platform. If they're not sure what happened, we just ask them short questions during a quiz. That's one way. Another way is partners can also leverage our post-report API to report scams in bulk programmatically. And as a result, as mentioned, we are powering one of the largest, probably the largest, database of scams worldwide multi-chain. There are currently over 300,000 reports. And we also provide a confidence score for every contributor, trusted contributor score to verify information. And people are also able to leverage this information to filter it across different scam categories, dates, chains, etc. And as a result, our partners are able to leverage this information to really make Web3 safer for their community and for themselves. So the first way we do that is anyone for free can check addresses or domains on Chainabuse seamlessly and access scam reports before they sign transactions. That's one way. Another way is we are also launching super soon, this is something you see in exclusivity here, a safety support center. So if people want to access preventive education content, if they want to know about safety practices, or if they've been scammed and they want to know what are the options for recovery, this will all be in one place. They can access this content. It's both for Web3 users and the users of our partners directly. Another way people leverage our information partners is they consume our direct API to alert users seamlessly within their product. So here, just saying an example, we partners with numerous leading wallets, even if you haven't announced it yet, which basically consume our API. And before the user is about to make a transaction, a potentially dangerous transaction, they're gonna simulate it, screen it against our database. And if the user is about to make a transaction with either a URL and address, which is in our database, they will alert them, either allowing them to see the reports or just blocking the address up to them. So that enables users to really be alerted directly where scams often happen seamlessly. Something else we are doing is not just enabling people to be alerted before they get scammed, but also, unfortunately, when scams do happen, be able to allow them to report the scams and opt in to get instant personalized support. So here you see an example of how it works. It's a sanitized example of one of our partners. So let's say you want to report a scam, you go directly in the partner's product, you click on security, report a scam, and you can learn more about Chainabuse, you can report seamlessly, and then at the bottom, you can just, as you report your case, you can request support. It's all free and instant and personalized. And if you do request support, instantly you will receive an email including advice on what to do immediately to protect yourself, advice on what to do next, personalized advice on how to contact law enforcement based on where you're based, optional investigative support powered by our leading investigator, and links to the dedicated articles. And partners like to implement this link directly to their product to allow the users to self-report, but obviously you can also do it directly on our platform as you report a scam. And lastly, what we are enabling, which is not live yet, is as we are building this database and maintaining this database of scams across so many categories and chains, we want to be able to also give back to our network, helping them detect the threats targeting their community. So building dashboard that will display trends, patterns, insights, link cases, emerging categories of scams, so they can better protect their community in return. That's a general view of what Chainabuse does for this space. We're hoping to do a lot more. If you have questions and now you're feeling, okay, sounds great, I want to contribute, how can you contribute to Chainabuse? It's all free. How can you do it to help us make the space safer? There are 3 simple ways. Either, of course, you can report a scam seamlessly on our platform, chainabuse.com, and opt in to get support, or it will help us alert the space in real time. You can, of course, spread the word on Twitter to people you know who would love to partner with us, organizations, so foundations, wallets that we mainly support, dapps, etc. And you can, of course, you're welcome to contact us to directly partner with us to protect your community as you join our network. So thank you so much for listening, and I hope you join us soon to make Web3 safer for all. And thank you again to our partner Hedera for supporting us here.
I'm excited to be a part of Hedera's ecosystem event today on the Security Day, and my name is David Melnick, and I represent LedgerWorks, and more specifically, LWorks Security. What I'd like to do is take you through a very exciting offering we're bringing to the community that I think sets the stage for where Hedera's security is going to be in the future, and it really sets Hedera apart. My team, who's not fully with me here today in person, but is with me in spirit, includes Steve Elfenbaum, our CTO, and a team of engineers who are actively working in our Discord channel and working with our community of developers. And so as I dive in today, the problem we're working to solve on the Web3 space is a problem we're all familiar with, as we've been working so hard and so quickly to build capabilities in the Hedera ecosystem. You know, the idea of focusing on security, tends to not be the primary focus. We're really focused on feature and functionality. And that's clearly what's happening across all layer 1 communities, as demonstrated by the losses we're experiencing, by the consumer losses. And to the extent that there is security in our Web3 space, it tends to focus on auditing of smart contracts, on code review to make sure that we haven't introduced any vulnerabilities. But we can and we will be doing more. And so as we look at the security landscape today, focused on identity and investigations and audits, Hedera and LedgerWorks are pioneering, moving beyond what's available in today's ecosystem to where we need to be in the future. So what if you could simply connect your wallet and a service would identify and inventory your crypto assets, register those assets for monitoring, and then configure quickly with you a set of security and protective controls that would in real time be monitoring your assets to protect you, including a rich notification capability. I'll just give you an example of a quick demonstration of where we're going, and this is going to be available in beta in January of 2023, and there will be tokens issued for that beta, so we're excited for that drop coming up. But imagine that you really are just creating a basic subscription and getting that token, connecting through, in this example, your Hashpack wallet, right, using HashConnect, right? You make that connection, and immediately your account has been registered for monitoring. So you have the ability to then configure. If I have an account registered here and I want to get notifications via email or via Discord, maybe I have a private Discord or Slack, I can immediately say that, hey, for any HBAR transfer that's taking place over a certain level, for any fungible token transfer in general, non-fungible tokens that are being transferred, tokens that are being associated to this account, allowances, balance changes by threshold, that for any of these events, right, you're going to be able to not just register those and have notifications, but be able to then look at the history of those very quickly to identify any alerts that would have occurred via that token, past, present, and future. So just to recap what a basic service offering to protect your wallet's assets would look like and will look like. You would identify and inventory your crypto assets, right? We're talking about just a simple hash connect, a simple NFT token for authentication and subscription, and LWorks will identify and inventory those accounts and assets. Beyond that, all of them are going to be registered, and our Sentinel platform is going to auto-configure rules on our platform for all that activity, so that we've got it registered on Ledger. And then our Sentry is going to implement those basic monitoring controls to observe and register those assets, configure those, and allow you to set up the notification rules. But I think what's really exciting about where this is going is that what I showed you quickly was a set of very basic notification controls. We will shortly be introducing a whole set of extended controls, time series, data-based controls that will allow us to do anomaly detection, right? That behaviors that are outside of norms can be alerted. We'll be looking at the accounts that you're interacting with and in real time able to run risk assessments against those accounts, so that if an account is, let's say, connected to a specific kind of, in the broader world, sanctioned accounts, those accounts, if they have assets or are relatively new, would be a risk. There's a number of capabilities around controls that will identify accounts you're interacting with, whether they're recently created, whether or not the assets in those accounts are recently added or have a history, whether or not your interaction with them is connected to something that's sanctioned or in other ways deemed a risk. And finally, notification. LWorks ingests all on-ledger data, right? Every 400 milliseconds, we're bringing in all data that's reached consensus as a part of our mirror. And the rules that we are running at scale against the entire Hedera ledger. And those rules are capable of complex relationship sort of triggering so that you could be notified with a whole range of activity. So in short, as I sort of complete this quick introduction to LWorks chainmail platform, you'll be able to easily connect and register your assets, quickly configure monitoring controls and notifications, and act with the knowledge that our 24/7 monitoring solution is continuously protecting your assets, from unauthorized notice action, that you will know if something's happening with your assets in real time. And our beta is coming via token drop in Q1. Please don't hesitate to reach out at lworks.io. You can see some additional information at lworkssecurity.com. And we're going to be promoting a beta access token drop that will give members in our community free access to help us work with and test this service as we go into beta. And we're excited to provide this service and capability to our community, and to work with the folks in the community to improve this. We're working actively with Hashpack, for example, so that we can push notifications directly into their wallet application on your iPhone or Android. So, the ways we can tightly couple with existing providers and existing players in the community. And we're looking forward to your feedback and your involvement so that we can make this, product better and move Hedera forward with the kind of security that will set us apart. So with that, I'd like to turn it back and just say again, thank you for your time and look forward to LWorks Chainmail coming in the new year.
Happy Friday all. What an awesome Hedera Ecosystem week that was. I hope you've enjoyed the variety of sessions that we've put together for you, and I definitely welcome you to let us know which were your favourites and what you'd like to see more of for next time. I'd personally like to thank the creators, builders, projects and companies that stepped up to be part of the sessions that we held this week. It's always so good to hear your stories and input firsthand. We absolutely could not have done it without you. And of course, a huge thank goes to my fellow Swirlds Labs employees for the efforts in putting together this week and organising it all. But by all means, I'm saving the best till last. Thank you to you, our Hedera community, by far the most engaging, supportive and committed community we could ask for. Your projects, creativity and innovation is inspiring, and we absolutely want you to keep it coming. Now, before I wrap up, I'd encourage any of you that are new to our community to head over to Twitter and give Hedera a follow. And if you haven't already, jump into our Discord, which you can access by going to hedera.com/Discord. Now, in Web3, technology is nothing without its community, creators, builders, and collectors. We see you, we appreciate you, and we look forward to seeing what you build as we wrap up 2022 and head into 2023. Stay safe and have yourselves a great weekend. Take care.